Book value, in the context of accounting and finance, is the net value of an asset as it appears on a company's balance sheet. It is an accounting measure that represents the historical cost of an asset less its accumulated depreciation. Book value is a key metric used to assess the worth of an asset from an accounting perspective. Calculating book value. The basic formula for calculating the book value of an asset is book value equals original cost of the asset, accumulated depreciation. Book value equals original cost of the asset minus accumulated depreciation. Key components. Original cost. The original cost, also known as the historical cost, represents the actual cost incurred to acquire or produce the asset. This includes the purchase price and any additional costs necessary to bring the asset into its intended use. Accumulated depreciation. Depreciation is the systematic allocation of the cost of an asset over its useful life. Accumulated depreciation is the total depreciation expense recorded against the asset since its acquisition. It reflects the portion of the asset's original cost that has been expensed over time. How book value reflects asset worth. Historical perspective. Book value reflects the historical cost of an asset rather than its current market value. As a result, it provides a snapshot of the original investment made in the asset. Depreciation impact. The deduction of accumulated depreciation from the original cost accounts for the reduction in the asset's value over time. Depreciation acknowledges that assets generally lose value as they are used or age. Useful life consideration. Book value considers the estimated useful life of the asset. The allocation of depreciation over this period reflects the assumption that the asset's value diminishes gradually over time until it reaches a residual or salvage value. Balance sheet presentation. The book value of an asset is reported on the balance sheet, providing stakeholders with a clear representation of the asset's net worth as per the company's accounting records. Asset valuation for accounting purposes. Book value is primarily used for accounting and financial reporting purposes. It helps companies track the historical cost and depreciation of assets over time, aligning with generally accepted accounting principles, GAAP. Comparison with market value. While book value is an important accounting measure, it may not necessarily reflect the current market value of an asset. Assets such as real estate or investments may have a market value that differs significantly from their book value. Implications for investors. Investors may use book value as a metric to assess the financial health of a company. Comparing the book value per share to the market price per share can provide insights into whether a stock is undervalued or overvalued in the market. Book value per share. Book value can be expressed on a per-share basis, known as book value per share. This metric is calculated by dividing the total book value of the company's equity by the number of outstanding shares. It is used by investors to evaluate the intrinsic value of a company's shares. It's important to note that while book value is a valuable accounting metric, it has limitations, especially in industries where asset values may be significantly influenced by market conditions. Investors often consider a combination of financial metrics, including market value, earnings, and growth prospects, when making investment decisions.